Welcome to Capital Budgeting Cash Flows second session. This session we are going to find the relevant operating cash flows associated with the proposed capital expenditure. Also, we're going to look at we are going to determine the terminal cash flows associated with a proposed capital expenditure. So what is net working capital? It is the amount by which a firm's current assets exceeds current liabilities. And however, we deal with the change and not in absolute terms of assets and liabilities. Hence, change in net working capital is the difference between a change in current assets minus change in current liabilities. Now, since current assets increase at a higher speed than current liabilities, hence we are going to buy more assets, and this results in outflows. This will also give us the net working capital as positive figure. If it's negative, then it will be the other way around. We are selling our assets and we are receiving the amount, and that will result in inflows. So let's look at an example. DC, a metal product manufacturer, is contemplating expanding its operation. The table below summarizes the expected changes in current accounts. Here the cash is increasing by 4,000. Receivable inventories are also increased by 10,000, 8,000 respectively. The total current assets is increasing by $22,000. Then we have accounts payable, which is also increasing. So receivable, what we will receive, and payables, that what we are going to pay to the creditors. So accruals also increased by 2,000, and total current liabilities increased by 9,000. The net effect is increase in 13,000, which is plus, which means that we are this is going to be the this represents the outflow. If it was negative, then it would have represented inflows. Let's look at this example of finding the initial investment, calculating the initial investment. PC is trying to determine the initial investment required to replace an old machine with a new, more sophisticated model. The proposed machine purchase price is $380,000, and an additional $20,000 will be necessary to install it. So together this becomes $400,000. It will be depreciated under using a 5 years recovery period. The present old machine was purchased 3 years ago at a cost of $240,000 and was being depreciated under MACRS using a 5-year recovery period. So present machine was purchased 3 years old, so already 3 years depreciation has been charged and 2 years have been left, while a new machine or proposed machine will start fresh depreciation from the year 1. The firm has found a buyer willing to pay $280,000 for the present machine and to remove it at the buyer's expense. The firm expects that a $35,000 increase in current assets and an $18,000 increase in current liabilities will accompany the replacement. The firm pays tax rate of 40%. So we can see that current asset will increase by $35,000 and current liabilities will also increase by $18,000. Apart from that, the $280,000 is the sale price, and so this is so let's look at it, how to formulate the initial investment. So we have the cost of proposed machine, $380,000, installation cost $20,000, and when that becomes the $400,000. Then we have the after-tax proceed from sale of present machine. A present machine, if you remember, it's 3 years old. So proceeds from sale of present machine is $280,000, that we all know, with all the cost included in it, minus tax on sale of present machine, which is $84,160. Now this is the point that we have to deliberate a little bit more, from where this $84,160 came. So how do we calculate the book value? So book value equals to the initial purchase price minus the accumulated depreciation. This is how we calculate the book value. Now, in this case, we have the asset is 3 years old, which means that we have the Macker's 5 years. The first 3 have been applied to this asset, and that constitutes around each year is 20%, the first year. Then we have the second year, which is 32%, and the third year, which is 19%. That comes out to be 71%. Now, the amount that we have, the initial, the asset is $240,000 when it was bought. Then we have 71%, which is depreciated. So we are left with 170,400. Now, if we subtract this amount from 240,000, so this will give us the book value, which is 240,000 minus 170,000, and that comes out to be $69,600. Now, sale price minus the gains, sale price minus the book value, and that gives us the gains, and that will be $280,000 minus 69,600, and that comes out to be 210,400. Now, if we multiply this with 40%, we'll receive 84,160 as the tax that we have to pay on it. The total after tax proceeds are 195,000. Change in net working capital, as we already established, it was the 35,000, and the liabilities were 18,000. So if you subtract it, you get 17,000. So the initial investment will be 160,000 that we'll consider. So now let's focus on operating cash flows. In operating cash flows, we are going to look at the benefits expected to result from proposed expenditures on an after-tax basis. Why? Because the firms will not have the use of any benefits until it has satisfied the government tax claims. The second is all benefit expected from the proposed project must be measured on cash flow basis. So we are not looking at accounting profits, we will look at the dollars, which means that we are going to add back the non-cash charges, for instance depreciation, amortization and depletion, back to the net profits after taxes to bring the accounting statement to cash flow statement. Finding the operating cash flows, the final step in estimating the operating cash flows for the proposed replacement project is to calculate the incremental or relevant cash flows. Incremental operating cash flows are needed because our concern is only with the change in operating cash flows that results from proposed projects. So what new cash flows comes way beyond than way beyond the existing cash flows that the project is offering. So a new project brings new cash flows, and those new cash flows has to be taken into account and not the existing cash flows of the company. You can look at this example where PC revenue expenses has two machines, proposed and present machines. Now revenue and expenses are clearly here. With the proposed machine, revenues are given here for 5 years and expenses are given here for 5 years. And with the present machine, we have revenues of 2.2 million all the way to, on average 2.2 million for the present machines, and expenses are also given here. So now we are going to work with these two machines to see to find the incremental cash flows and incremental operating cash flows. So we know that depreciation with Macker's, how it works. However, Let's look at it. The proposed machine, the depreciation is $400,000, and 20% depreciation in the first year will turn out to be $80,000. So 5 years Macas means it will depreciate it over 6 years. So this is fully depreciated amount. You can see 400,000 is the total cost of the asset, and it is fully depreciated over 6 years at 5-year Macas. So let's look at the depreciation expense for present machine. In present machine, we have already depreciated for 3 years. So Macca's 5-year leads to 6 years depreciation over 60 years depreciation, and the machine has already incurred 3 years of depreciation, which was equal to 71%, total 71%. Now what is left will be depreciated in the first year, and you can see this is the first year depreciation, this is the second year depreciation. Actually this is the, if you look at it, it's the fourth, fifth and sixth year, because the 1, 2, 3 has already been depreciated, and that's equal to 71% of depreciation. Since we are matching present with the proposed machine at a specific time line, which is today, hence we are going to start comparing what depreciation has been left and what happens after 6 years of depreciation. So for these 3 years, the present machine is at the end of the third year of its cost recovery, and the analysis performed, it has only 3 years of depreciation, which has been already charged here. So nothing will be done here, hence we have a total value of the book value of the machine, which will be left as 69,600. Now this is the general format. We have revenues, expenses, then we have EBDIT, which is depreciation, interest and taxes, and then we charge the depreciation, taxes, and then finally we have net operating profit after taxes. Now adding back the non-cash items, here we have only depreciation, so we'll add depreciation back, will give us operating cash flows. Let's calculate the operating cash flows for the PC company. Here are the operating cash flow for proposed machine. Is over 6 years. Why it's over 6 years? Because Macca's 5 years leads to 6 years depreciation, hence the 6th year. We have revenues, expenses subtracted, depreciation subtracted, and then we have to apply taxes. You can see that we have the depreciation charged to 6th year as well, and so earnings before interest and taxes is there is a loss in the 6th year, and then we have applied a taxes, which is minus 8,000, which is also negative, which is, when the tax is negative, is tax saving. Then we have net operating profit after taxes, which is also negative. Then we have depreciation, which is we add back all the non-cash items. This helps to calculate the operating cash flows, which is given the next line. And now we have all the figures for operating cash flows. Let's look at the operating cash flows for the present machine. It is also over 6th year. So this is 1, 2, 3, 4, 5 and 6th, because it also follows the same Macca's 5 year with the 6 year depreciation, and we apply all the revenues, expenses, depreciation the same way. And since it's only can be depreciated for the 3 years, because already 3 years has been charged, so we have no depreciation in the subsequent year. And you can see that when we add back the depreciation or the non-cash item, we have, these are our cash flows. Now what is the incremental cash flows? Proposed machine and present machine. So we see how much the value proposed machine add over and above the present machine. So when you subtract it, you get the incremental cash flows, and see all of them are positive, and this positive means that there is some value that has been added over and above the present machine could have added. So now we are concerned with the terminal cash flows. Terminal cash flow is the cash flow resulting from termination and liquidation of a project at the end of the economic life. It represents the after-tax cash flows exclusive of operating cash inflows and occurs in final year of the project. The proceed from sale of the new and old assets, often called salvage value, represents the amount net of any removal or cleanup costs expected upon termination of the project. So that's what we have to look into. If the net proceeds from the sale are expected to exceed the book value, a tax payment shown as an outflow will occur. Or if sale is less than book value, a rebate will be shown. A tax rebate will be shown. So sale is greater, so obviously there is a gain and hence we have to pay the taxes. If sale is less than the book value, there is a loss, and the loss means that the tax will be returned. When we calculate the terminal cash flows, the change in net working capital represents the reversion of any initial net working capital. So inflows becomes outflows. We have to sell the assets and pay back the liabilities. So the signs becomes different because the project will be closing down, and we are going to recover our investments in the net working capital. So most often this will show up as a cash inflow due to the reduction in the net working capital. With the termination of the project, the need for the increased net working capital investment is assumed to end. So this is the basic format for determining terminal cash flow. After tax proceeds from the sale of new assets, so it's a new assets, and this is for the old asset. Proceeds from sale of new assets plus minus tax on sale of new asset. Similarly, old asset we are going to sell, and then we are going to look at the proceeds from sale of new assets, from sale of old assets plus minus tax on sale of old assets. So we can have a gain or loss on the asset, hence we have both signs available here, the gain or it could be loss. Similarly here, so whatever the change in net working capital, it will get the we'll add it or subtract it, and then we'll get the terminal cash flow. PC expects to be able to liquidate the new machine at the end of its 5 years usable life to net 50,000 after paying removal and cleanup cost, which is already charged. The old machine can be liquidated at the end of 5 years to net $10,000. So new machine 50,000, old machine will be 10,000 sale point. The firm expects to recover its $17,000 net working capital, which we already calculated at the beginning of the session. And upon termination of the project, the firm pays tax at a 40% rate. Let's look at the same question in the terminal cash flow format. So we have after tax proceeds from the sale of proposed machine. First we'll look into this. We have proceeds from sale of proposed machine, which is $50,000, and tax on sale of proposed machine is $12,000. Now, from how we calculated this at 40% rate. So this is basically we have the sale price, which is $50,000, and we subtract it the book value, which is $20,000, and that comes out to be $30,000. If you multiply with the tax rate of 0.40, you'll get the $12,000. So this is basically the gain, and on this gain we are going to pay the tax, and that tax is charged here. So total after tax proceed will come out to be $38,000. So from where this 20,000 came? That's also a question. Let's calculate this. If you remember, we have $400,000 we purchased the asset, the cost of the asset, and the depreciation under Macker we charged was around 400,000 over 6 years. However, we sell the asset at fifth year, which means that its total depreciation is about $380,000. So that comes out to be $20,000 for the 6th year depreciation, which is supposed to be charged, but we sold it just a year earlier in 5th year. So this 20,000 is basically left as a book value. Now the 50,000 we sold it, 20,000 was the book value, so 30,000 is the gain, or we can also call it recaptured depreciation. Let's look at the second part. After tax proceed from the sale of the present machine. So proceed from the sale of a present machine is 10,000 and tax on sale of present machine is 4,000. And this is pretty straightforward because we have the sale price is 10,000 and the book value of this asset is 0. We have depreciated the entire cost of the asset. So we have no book value, hence we have only 10,000 left as the amount, and over this we are going to charge the tax, which will give us the 4,000. So the net total after tax proceed of the present machine is 6,000. We already know the change in working capital will be 17,000. So we get the terminal cash flow, which is 49,000. So let's summarize. Initial cash investment operating cash flows and terminal cash flows together represents a project's relevant cash flows. These cash flows can be viewed as the incremental after-tax cash flows attributed to the proposed project. They represents in a cash flow sense how much better or worse off the firm will be if it chooses to implement the project. So we are going to now combine everything and see the value of it. So this is the timeline of PC relevant cash flows, and you can see this was the initial cash flow that we calculated. These are the incremental the incremental cash flows, or the proposed machine cash flows, and this is the terminal cash flows. So the last cash flow has the terminal component as well as the operating component, which is mentioned here. So this is how we calculate the three parts of the project: the initial, operating, and the terminal cash flow. We did this in this session. We found the relevant operating cash inflows with the proposed capital expenditure, and we also determined the terminal cash flow associated with proposed capital expenditure. You can also apply the capital budgeting technique of calculating IRR and NPV on these cash flows to find out how much, what is the IRR of the project, what is the NPV of the project. Thank you.